Welcome to Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. Today, we're diving into a pivotal shift in the world's largest energy growth story, China's refined oil market. For years, the narrative was simple: rising domestic demand and export arbitrage. But our spotlight today is on GL Consulting's special report, which reveals a new reality unfolding through 2030. The market is now governed by policy timing, compliance discipline, and differentiated consumption patterns. Here's the breakdown. First, domestic demand. We're seeing a structural erosion, not a cyclical dip. Gasoline and diesel consumption is weakening irreversibly, driven by the explosive growth of electric vehicles and LNG trucks. The story is no longer about short-term recovery, but a permanent redistribution of fuel consumption. Jet fuel remains among the few refined oil products maintaining steady growth, driven by aviation expansion and a gradual recovery in passenger mobility. Second, export dynamics. China's persistent oversupply means exports are crucial, but forget arbitrage. It's now all about policy cycles. License availability and policy windows, not market opportunity, set the pace. Export ceilings are now defined by policy corridors under the dual carbon framework. Third, policy transition. Recent tax reforms and stricter compliance are redefining profitability. With export rebates cut and licenses concentrated among major players, smaller refiners face rising barriers to participate in overseas trade. Margins now depend as much on compliance as on configuration. The narrowing profits margins on gasoline exports, combined with greater oversight of feedstock traceability, are accelerating consolidation within the refining sector. So, what's the outlook? A transition from volatile arbitrage to a managed balance. Production, exports, and profits are increasingly shaped by coordination, not just competition. In this new environment, there are three key developments to watch. First, consolidation and compliance pressure. Policy-driven concentration continues as smaller, non-compliant refiners face reduced market access and tighter documentation requirements. Second, integration momentum. Large state-owned and private complexes leverage petrochemical synergies to sustain utilization and margin resilience. Third, trade normalization. Quota-guided exports replace opportunistic surges, anchoring trade within predictable corridors. That brings us to the close of today's discussion on China's rapidly evolving oil market. The insights you just heard are drawn directly from GL Consulting's exclusive report, Thriving in Turmoil, Unveiling the Future of China's Oil Market, 2024 to 2030. This report offers the depth behind today's headlines, combining proprietary data from over 150 refineries with sharp policy analysis and forward-looking projections. To access the complete report, feel free to visit mysteel.net, that's mysteel.net, where you can request a sample. We're happy to guide you through it. You're also welcome to reach out directly for our free white paper series. Just email us at inquiries@mysteel.com. We'd be glad to connect. Thanks for tuning in to Commodity Flux. If you found today's perspective useful, be sure to subscribe for more insights on global market shifts. Until next time, keep tracking the flows.